There are three crucial concepts we must discuss. They're all related, and they're more relevant than ever. Predicting future markets, a yield curve that's steepening once again, and pivot points. First off, today's news. Growth is improving. We're talking about GDP. It was revised up to 3.3%. That's up from the prior revision of 3%. So, certainly good news. In fact, GDP is now at a level we haven't seen since late 2023. Certainly welcome news to the market. As a result, the odds of an interest rate cut in September decline, but only a little. We currently have an 85% chance the Fed will cut rates in September. That's down from yesterday's 89%. Certainly a lot higher than where we were on August 21st at 75%. That was that Fed statement. Here's the message from the bond market, and this certainly is very interesting. We take a look at the short-term yields like the 13-week Treasury. On August 1st, they were 4.18. Now they're just above 4%. What happened? Well, August 1st represents those awful employment numbers that were released that sparked the Federal Reserve into action. Well, the anticipation of action that they'll cut rates in September. During the same period of time, the longer-term maturities at the 30-year, they've risen from 481 almost to 5%, just a little bit off highs at the moment. So what's happening here? The short-term yields, the 13-week, they're moving down in anticipation of an interest rate cut. Short-term maturities tend to follow the odds of interest rate decisions. Longer-term maturities, like the 30-year, they're making a bet on long-term growth and or long-term inflation. And the distinction is important. We're going to tell you why. So this is called the steepening yield curve. That's when the gap between the long and short-term maturities widens, which is exactly what's happening now. It's happened in the past. For example, we have a bull steepening. That's a good thing. That happens when the short-term, the short end, the short-term maturities, they move down in anticipation of low rates that will stimulate economic growth. The long end, the longer-term maturities, well, they rise, anticipating an economic recovery. We go back to 2009. That was after the financial crisis. Take a look at the yellow line at the bottom. Those are the 13-week treasuries, the shortest term. And the white line at the top, the 30-year. Notice how that spread between the two is widening. That occurred when the short-term yields were tethered to very low interest rates. They didn't move for quite a long time. But those low rates created the perception, the anticipation of a strengthening economy over time. And that's why the longer-term yields move up. And that is exactly why we had a steepening yield curve, a bullish yield curve. However, there's also a bear steepening. That occurs when short-term rates, they stay low, and they're cut in response to a crisis. For example, if the stock market starts to crash, maybe the Federal Reserve will cut rates. Meanwhile, the longer end, the long-term maturities, well, those yields rise, anticipating inflation. The short-term rates and low interest rates create inflation. That's okay unless it happens without economic growth. And that's a bear steepening. That usually happens before a financial crisis. So again, the yellow line here, that's a 13-week treasury, the long, very short-term maturities. They declined precipitously in the year 2000. While during the same period of time, the longest-term maturities, that white line, the 30-year, that did not decline because of inflation. Inflation that was created in part because of the tech bubble and also low interest rates. Well, so we see a widening here, but this is a bear steepening. The distinction, the difference is this happened before the crisis, and it's thought that the Federal Reserve was acting too late. They were too late in cutting interest rates, and they were not able to avoid the crisis. Well, there's a new yield curve that's steepening once again. In blue, the 30-year, the yellow columns, that represents the short-term maturities. And what's happening, first off, the 13-week, the short-term, that's declining in anticipation, and this, by the way, is August 1st through present date, in anticipation that the Fed's going to cut rates in September, like we just saw. The blue line, the 30-year, well, that's moving up. It's wavered a little recently, but it is moving up over time in anticipation that over the long term we'll have higher growth and or higher inflation. But the distinction, again, is very important. If it moves up because of growth, that's a bull steepening. If it moves up because of the extra inflation from low rates, that could be a bear steepening. We spoke about this in our Substack newsletter. We got into quite a bit of detail describing the two different phenomenon and what we can expect from our current situation. We'll provide a link in the description of this video. Now, number two, using math to predict the future markets, that is. We use a tool called the Exponential Smoothing, ETS for short. Very simply, it's a method to predict future values based on a time series. It factors in different elements such as levels, trend, and seasonality. All that's not important right now. What is important is that ETFs behaves like a moving average of sorts. It gives more weight to the most recent prices, so changes that are happening now tend to affect this calculation more than changes that happened quite a long time ago. So it's an exponential moving average of sorts. Well, the reason why this is important is because of Friday. We're expecting very big inflation numbers, the PCE, personal consumption expenditure. Can we predict where this number will be? Well, this is the PCE over the past couple of years, the personal consumption expenditure. It's trended lower. What we can see on the right-hand side is that cloud with a white line in the center. The cloud represents a 95% probability of where the PCE could emerge based on the past 3 years of data. The white line in the center is the most probable, forecast where PCE is going to go. Where is it going to go? Well, at the moment, the ETS tells us, current PCE is at 2.6%. The ETS exponential smoothing, that predicts a July PCE number will be at 2.61%, basically where we are now. August will be at 2.7%, and September will be at 2.8%. So this math is predicting over time that inflation will continue to rise. We can also apply this math to the core PCE, which excludes food and energy. Over time, it has also declined. Well, the prediction is, over the long term, that core PCE, again, excluding food and energy, and the distinction is important, that will decline. Core PCE right now stands at 2.8%. The July report's expected on Friday. That's predicted at 2.72. August, 2.52. September, 2.45%. So notice the divergence, by the way, and this is quite interesting. This math, the exponential smoothing, is predicting that inflation, that will rise over time. But if you take out food and energy, it will not. It will actually decline. That, in other words, is telling us that food and energy is most likely due to rise. Now, that's just the math, our interpretation of it. So the objective in our new project, and this is a multi-part series, and we'd love to hear your feedback on this, is we're going to monitor several economic reports, including inflation, jobs growth, anything else, by the way, that you may be curious about. We're going to utilize the exponential smoothing, ETS, to project future economic conditions. And from those conditions, we can make an educated guess as far as which stocks to buy and sell. So, for example, if we have an educated guess, 3 to 6 months, maybe a year from now, where inflation is going to be, where the jobs numbers are going to be, we can hypothesize what are the best and worst stocks to own at that time. Well, we've spoken about this also in our Substack newsletter published just the other day. In fact, we detail which specific stocks, which specific sectors tend to perform the best and worst under different conditions, which we aim to project based on the exponential smoothing. So we ask you, join us at Substack and let us know about this new project that we're embarking on today, projecting future economic reports with exponential smoothing. We hope this has been helpful. We look forward to seeing you back soon.